Welcome to the show. Listen, today is Monday, April 16th, 2018, and I'm going to tell you what. I've got a lot happening in the markets, so let's get right into it, and let's start the charts right here. And the first thing we're going to look at is the silver price. She's been kind of shooting up, and just started shooting up, you know, in the last... I don't know, a couple hours. But now it seems to have found a level at around $16.70. So it's up 6 cents on the day. We've had quite a few gains. We're almost in a little bit of a territory where we could go back up to 17 bucks, which is great. I hope it goes over $17 again. I hope it gets up like $17.20 or $17.50 at the very least, because silver has been suffering for a long time. So we're having a little bit of uptime, and this is good for silver. Now, what we're going to look at next is we're going to look at the Dow Jones. Let me expand the charts here a little bit. We're looking at 146 points up this morning. I don't think it's going to be a real big up day today. I think that we're going to probably maintain that up, but the little up that we had, but it's really nothing much. It's still the Dow Jones right now is still like in a holding pattern. If it was in an airplane, it's circling the airport right now. That's what it's doing. If it was an airplane. Okay, so 24,506 right now, and now we're going to take a look at oil. Oil is down 64 cents, but I don't think it's a big deal. I think the overall trend is still upwards towards 70 on sweet light crude. I think sweet light crude might make it up to around 70 bucks. That means the crude prices are a little bit higher. What would they be? 72, 73. And then there's going to be a little bit of a slowdown for oil because I think production's going to increase. Unless something seriously breaks out in the Middle East, then we could see $100 oil very easily. If something serious, really serious breaks out in the Middle East, that's more of a permanent thing rather than just a quick airstrike in and out sort of a thing, like happened the other night. It didn't have really a chance to really affect the oil price because it was just like bing bang, it was over. You know, it was scary and everything at the time. We could have started World War III, but it didn't happen. Russia didn't react or anything. Russia hasn't done anything so far. It's been a one-sided battle, you know, and it doesn't appear to have caused too much problems so far. So let's take a look at cryptocurrency. And what we see is Bitcoin sliding a little bit today, but I don't think that that's going to last. I don't think there's going to be a whole lot to that. I think basically we're finding a new range up in here around 8,000 bucks. You know, and so she's at 79.55 right now at Bitstamp. I could see it going as high in the short term as 10,000. And I predicted this whole thing from 6,800 up to what it is now. And I predicted that this would happen, a little bit of a melt up before the stock market crash. And as the stock market starts to crash on its way down to 20,000, we're going to see this melt up even get stronger. Because as so many people think that cryptocurrency right now is a safe haven asset. That's what they think right now. Cryptocurrency right now is a speculative investment. It's going to become a safe haven asset, but it's not a safe haven asset yet. It's a speculative investment right now. And this means because it's a speculative investment, when the real trouble comes, people will run to real safe haven assets, which is gold and silver and cash. They'll want to be in cash. And those are the places people run when the earthquake begins, when the tidal wave comes, when the stock market falls 5,000 points, when the world starts to shake to pieces. Then they get frightened of cryptocurrency because it's not really a safe haven asset. They think it is, but it's not. It's a speculative investment. And the reason why it's a speculative investment is, you tell me, if you buy some cryptocurrency right now, like Bitcoin, you tell me who's going to take it, just in general. I mean, you got to go to a specialty place. You've got to go to an exchange. I mean, all the banks could clamp down on these exchanges overnight. You know? And where's your value in cryptocurrency at the moment? Now, it's going to win. In the end, a few years down the road, you come back 5 years from now, and this whole situation will have changed. Cryptocurrency will have been adopted. The fiat currencies will have died. And we'll be in a whole different world where cryptocurrency will be the safe haven asset, the place to have your money. But right now it's not there yet. But they're treating it like it is, an awful lot of people, because they're just so into this. It's like this is the next big thing, and they're all excited about it. They're really excited about it. And they've invested their money in it. And yes, it is going up. But when the world starts to come to pieces, and the reason why the world's going to come to pieces is I'm going to explain to you in a minute. I'm going to get into this, why everything's unraveling at the seams. But I'm not going to complete it. I'm just going to talk about a couple things, why the world's unraveling. But, well, we better get to it. Okay, so that's what Bitcoin's doing. Let's take a look at cryptocurrency market capitalizations here. Right now we're looking at 318 billion, so we're up. But even though we got red numbers, Cardano's the only green number I see on the board. All the numbers are red. Litecoin's 125 bucks. Bitcoin Cash is 745. Ethereum's 500 bucks. Ethereum's a good buy right now, I think. Litecoin's a good buy. Bitcoin Cash, pretty good buy. EOS is $7.84. IOTA's $1.53. I like IOTA. You know, I like NEO. NEO's 64 bucks. I think NEO's a good buy right now. Monero, nice coin, really nice coin, 189 bucks. Dash, really nice coin, 356 bucks. That's a good buy for a Dash. That's a good buy. Anyway, okay, so that's enough of that. Let's move on to bonds and rates. And let's take a look at the 10-year. And this is what I expect. Here's what I expect. All of them are going, all the yields are going up right now. They're all on the way up. I'm going to take a look at the U.S. 10-year specifically. She's back on her way up again. You know, she's starting to go back up again. I think what happened was, you see this rise up in the U.S. 10-year right here? And it peaked around February 21st. It peaked at 2.9, was it 2.95 or something like that? And then what happened is it started to go down again. The yields started to fall again. And they fell down as low as 2.72% on April 2nd, 2018. They fell down to 2.72%. Well, now they're back on the rise again. I don't know what this was. I surmise that it was some sort of hanky-panky by the Fed. And I think that the reason why they pulled this hanky-panky was because they saw the stock market fall, and it scared them. And it scared them out of their bond program for just a short period of time, what they were doing with their program of what they called quantitative tightening. I think it scared them out of that program, and they didn't tell anybody. I think what they did was they went out and they countered what was happening in the stock market. And I think that's why we've seen the stock market recover. But I think it's only a temporary thing. I think now they're starting to go back to what they were doing again. And I think that when we saw them go back to what they were doing again was right here on April 2nd, I think is when they probably decided the 1st of April they would go back to what they were doing again, which is quantitative tightening for real. And look, the bonds started to go up again. And now this yield's going to continue to climb, and I think we're on our way. They're hoping that the stock market, hoping against hope, the Fed, that the stock market won't do that again, won't shock again, so that they can continue with their quantitative tightening. I think what happened was that stock market shock that we had stopped them from doing what they were doing, and they went back to easing again. But they did it secretly, I think, just for a short period of time, a limited period of time, so that they could give the stock market stability again, give the stock market what's called legs. And now they think that the stock market has legs because now it's basically going sideways again. So they're thinking to themselves, okay, we'll get back to our quantitative tightening. And so I think that's what they did on the April 2nd. They went back to it, or 1st of April. And now what we see is we're starting to see a slow rise. If we take a closer look to this, let me see, can we get in closer? Maybe not. We can bring the chart in closer, okay? So we get a closer look at when the turn was. Bring the chart right in. We can do this. We can do this. This chart will go right down, and it'll show us that this right here, this was the bottom there of the bond yields falling, and now this turned, and now it's going back up again, you see. And I think that's going to continue. I think we're going to surpass 3% now. I think this is it. This is the move. We're going to surpass 3%, and we're going to start to head toward 0.3.25. By them doing their hanky-panky maneuver, I think they bought us a little bit of time. You know, I think that's what they did. They bought us a little bit of time with their hanky-panky maneuver so that the markets will stay steady a little bit longer before our big crash, which is probably going to come. They might be able to hold it off till this fall. They're awful full of tricks, you know. They have the exchange stabilization fund and everything else working to their advantage. So anyway, now let's move on to the U.S. dollar, which today is sliding. We got a sliding U.S. dollar. Right now it's sliding. And that's why gold and silver prices are going up. Right now we got a sliding dollar. There's an inverse relationship between the dollar and gold and silver. Dollar goes down, gold and silver goes up. That's the whole thing, you know, an inverse relationship there. The more gold you can buy with your dollar, you know, it's an inverse relationship anyway. Now, ECB, what we're going to talk about right now, is the ECB has told Deutsche Bank to simulate a crisis scenario within their own bank. And here's the chart of it all. And what it basically amounts to is this number right here, 48. Okay, that's $48 trillion of euros. Well, I shouldn't say dollars. I'm so used to saying dollars, okay? But it's 48 trillion, over 48.3 trillion. That's the number that they come up with. $48.3 trillion worth of derivatives that they have on their books. And so they're supposed to do they're supposed to figure it out for the ECB. What would happen if they had to completely melt down Deutsche Bank? And so what we're talking about here is complete meltdown of Deutsche Bank. And Deutsche Bank is having to do the math and tell the ECB what the consequences will be if they completely melt down. This is not a good sign. This is a sign that Deutsche Bank is probably getting ready to melt down. And the ECB wants to know what the ramifications will be. The European Central Bank wants to know what the ramifications is going to be and what problems it's going to cause to the world's financial system if they have this meltdown of $48.3 trillion derivatives book. The result of this is probably going to tell the ECB, I'm just saying probably, that they can't let Deutsche Bank completely melt down, that they're going to have to step in and they're going to have to rescue this bank with a bail-in, or a bailout, I should say. They're going to have to bail them out. But what kind of money is it going to take to bail this bank out? I mean, if they got a 48, it's going to take a lot of money anyway to bail them out. It's probably going to take at least, I'm just going to say probably at least $20 billion of euros. I mean, 20 billion euros. It's going to take at least 20 billion euros to bail this bank out. at very least. And this is a money pit. If they throw $20 billion into this, 2 years later, it's going to need it done again. This is a money pit. This operation is a money pit. Now, the Italian banks are the same thing. They're a money pit. The Italian government now has borrowed as much as they can possibly borrow. They threw 20 billion euros at their banks not long ago, and the banks have probably already went through half of it, to tell you the truth. Well, they go through it like poop through a tin horn. Here's the thing. Now let's take a look at Deutsche Bank stocks today. You see what's happening here? They're sliding down on their slippery slope to hell. That's what Deutsche Bank stock is doing. If we take a look at the 5-year here, we can see that it's just been, this was the buyers. There's a bunch of stupidity, buyers coming in, you know, and it reached the bottom here around the September of 2016. And now she's back down near her bottom again. I think she's heading toward another bottom. You know, if we go through the 1 day here, see, she's sliding. She's sliding. Anyway, Deutsche Bank is possibly not the Lehman moment that's coming. Wells Fargo, you know, I think they do an awful lot of lending to mortgages, you know. They do an awful lot of lending to mortgages, and of course that's dropping way off now that the U.S. 10-year is going up and up and up, which is what they base all of mortgages and everything's based off of. And so because the U.S. 10-year is going up and up and up, the yields are going up and up and up, and they're on their way up today. They're on their way up right now as we're talking. This is having a very bad effect on Fargo, and the thing about it is ultimately Fargo is bigger than Lehman. I believe they're bigger than Lehman anyway. I should check it out. I think they are, though. They're awful big bank. And the thing about it is most of their business is based on these mortgages and stuff. And mortgage applications are way off. And the reason why they're way the heck off is because the price of taking out debt is going up like crazy, and it's going to continue to go up like crazy. There's no sign in sight that the bond market's going to slow down. It's busting, it's popping, the bond market. And as the bond market pops and as yields go up, we're going to see less and less mortgages, and we're going to see businesses starting to get in trouble. Like Wells Fargo could be the next one. And I'm telling you, if you take a look at Deutsche Bank over the last 5 years, take a look. Right? They've been bottom bouncing here for a long time. You see this? That's surviving, right? They might survive a little bit longer, even though they're dangerous. They might survive a little bit longer than the next Lehman, which could be some company in the United States like Wells Fargo. All of a sudden, you got a Lehman moment. All of a sudden, you got stock markets crashing and everything. But that would carry Deutsche Bank down. You see what I mean? Because Deutsche Bank's been surviving on this boom in the credit cycle that we've had with that they call the Trump rally. Deutsche Bank's been surviving on that. You'll notice that Deutsche Bank bottomed out just before the Trump rally back here in 2016, around July or whatever. It was bottoming out, and you notice what happened. She had a little bit of a climb up here, exuberance, the same exuberance buying the stock market. They were buying on the dip into Deutsche Bank, you know, and look, they drove it up here. They drove it up here all the way up to like 17 euro per stock, you know, and right now she's back down to 11 euro and falling. Look at today, you know. And so right now, 11.58 euro and falling today. Falling, and these guys, I don't think they're going to come rushing in to try to grab a fallen blade at this stage in the game with Deutsche Bank. Now, here's the thing. They had a lot of them come in because they bought it in. They got, I think they were people from Qatar or someplace, bought a whole bunch of Deutsche Bank stock. And then Deutsche Bank also, they sold their own shares. a huge share sale, and they diluted their shares. I mean, the investors must have just loved that. Deutsche Bank diluting their shares to come up with a whole bunch of billions of dollars so that they could keep running. And this is what happened. So now, what's happening now is Deutsche Bank, the ECB said to Deutsche Bank, hey, you know what? You're going to go down now. And ECB's told them to simulate that, to simulate a crisis scenario where Deutsche Bank is going down. And so they've charted it now, and they've come up with 48 trillion with a T derivatives book. And so prepare, batten the hatches, folks. I think the system's getting ready to come down. I think the Lehman moment, we're going to have another Lehman moment, but it's going to be a bigger Lehman moment than the last one, a lot bigger. So listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye.